This morning we've talked about wage developments, the role of wage growth in Germany. We've talked about fiscal policy. Now in the third panel, we'll combine all that and focus on the most endogenous macro variable I can think of, the current account position. And we have the difficult task to fight the after-lunch fatigue. So let me start with the obvious. For those of you who have a written program, I'm not Claudia Buch. She regrets she unexpectedly fell sick. So this is when you organize a conference mid-January in Germany, it might happen that influenza is having an influence on panelists and participants, but I will try to replace her. She sends her regards, and she very much regrets that she is not able to be here today. So, as my governor alluded to this morning, the current account of Germany has been in a surplus position since most of the post-war period, with the exception of the unification and the aftermath of unification. Now we have climbed up to over 8%, and the estimate for 2017 is a current account surplus of 8% of GDP. And the issue we want to discuss is this a problem? You can all take a view, I think my governor has taken that view, at least partial, to say, well, why should it be a problem? This is the outcome of a decision of millions of households, of companies, of savers and consumers, a highly endogenous variable. As long as we do not see any policy distortion, this should not be a problem. Or you could take the view coming from a saving investment balance. It indicates that we save too much, domestic demand is too low. Besides, we risk the international trade system by running current account surpluses of that magnitude. I will shy away from trying to infer distribution of views among the audience, but what we have tried to do is to invite a group of very distinguished speakers who, by the way, do not need any introduction, I would say, but let me just mention that we've invited Maurice Obstfeld. He's the economic counselor and director of research at the IMF. He's currently on leave from the University of Berkeley, and he was a member of the US Council of Economic Advisors from 2014 to 2015. And everybody who studied economics has come along one of his leading textbooks who have been and who are highly influential in formulating the views and perspectives about how we think about the international economy. We have Clemens Fuest, who is president of the IFO Institute in Munich. He has taught at the universities of Munich, Mannheim, Oxford, and Cologne. And he researches widely on fiscal policy issues, European integration, and has several policy advisory functions in Germany. Then we have Professor Jens Südekum. He is from the University of Düsseldorf, and he's a research fellow of the Center for Economic and Policy Research, the CPR, and a member of the CES-IFO network. He focuses very much on international trade and the impact on the labor market. And finally, and a special welcome to a former colleague of mine, this is Guntram Wolff. He is now the director of Bruegel, Brussels-based European think tank that specializes in economics. His research spawns issues related to European integration, macroeconomic theory, and he's been active in many policy fora. So that's up to the panels, and now the floor is for you, Maurice.
Okay. Thank you very much, Jens. I will focus today on the question, as the title indicates, of whether Germany would benefit from a smaller current account surplus. And I'll start off with the IMF's external balance assessment, which is, while it's multilaterally consistent, it looks at the current account from the standpoint of policies for individual countries that are optimal for them, not for the global system. So while the multilateral perspective, the role of the current account in the international monetary system, the trade system, is all important. And in fact, I think one of the risks to Germany, as Jens hinted, is within the trading system currently. I will focus on the domestic scene. I will first look at our EBA analysis, just tell you what it is, talk about some key consumption investment trade-offs that I think are helpful for thinking about the the current account, talk about how not to think about these trade-offs, because there's been a lot of commentary that I think goes down the wrong path. Think about what is good for domestic welfare, what might be good, and then I want to focus particularly on a topic that came up this morning, which is wealth inequality. So in terms of our external balance assessment, which we apply to a group of countries comprising about 85% of GDP, including Germany. Here you see Germany's current account balance. The blue bars are the norm, where we think Germany should be, and then there is a gap, which we would label as an excess current account surplus. If we decompose that gap, we see that the red part is explained by a deviation from our recommendations for fiscal policy, and I'll go more into a rationale for those, and also a big unexplained portion. This unexplained portion is quite controversial. Countries that are unhappy about such unexplained portions argue that the model is wrong, and if the model were right, then the unexplained portion wouldn't be there. We tend to take a more cautious view, which is also more multilaterally consistent. But certainly part of the German gap is fiscal policy. How do we want to think about the trade-offs involved in the current account? I want to just go through a simple diagram where we start off with GNP and think about how to allocate it. And there's a note at the bottom which you can read if you're confused. I'm not going to explain it. But basically, if we think of the amount of GNP you have, you can consume it, you can invest it. And if you invest it, you can invest it abroad or you can invest it at home. And if you've invested at home, you can invest it through private sector allocation or through public sector allocation. And what I want to focus on is this trade-off between investing at home and investing abroad. And that's really the key trade-off for thinking about how the current account is determined. Now, in reality, the world is much more complicated because you may have more than GNP to divide between consumption and investment, because you can also borrow abroad. And so really the far left bubble should be GNP plus the increase in gross external liabilities. And then you can take what you borrow and invest it at home, invest it abroad. Now, one point that is often made, and in fact I heard it this morning at coffee, is that the current account surplus is really wasteful for Germany because it's losing on its investments. And this is supposedly indicated by the divergence between the cumulated current account flows and the international investment position evolution, which you can see in the left-hand chart. Germany has roughly 2.5 times GDP in gross assets, actually a little bit more, roughly twice in liabilities. And just if you'll excuse me for being a little bit nerdy here, if you write down the equation governing the evolution of the NIIP, the international position, it looks like what I've written here. Change is equal to net exports plus the total return on assets less the total return on liabilities. Total return on assets is the R part, which is the sort of dividend and interest flow, the yield, and the K part, which is capital gains due to stock price movements, exchange rates, et cetera. And it's the current account captures the R's, but not the K's. So if the K's evolve in certain ways, you may find that the net international investment position does not track the accumulated current account. It could be more or less. But the overall return on these domestic and foreign assets is the R's plus the K's. If you look at these over time, and a number of people have done this, including the handout you got today, the excellent handout from the fund and Deutsche Bundesbank staffs. Daniel has done work on this. you see that actually the yield on assets exceeds that on liabilities. If you add in the capital gains, you see that they're roughly equal. So basically, there's no difference here. But I would argue that this is all kind of secondary, because what we really want to answer is the question of whether it's better to invest at home on the margin or invest domestically. So this involves the marginal private returns, but also, importantly, the social returns, which may differ from the private returns. It may be that investment at home has a very high social return beyond the market return. And a lot of this has been discussed this morning. Infrastructure opportunities, for example, broadband transport. There may be domestic investment obstacles, which means if you could dismantle them, the return to investment would be high. Educational investments, including early childhood investments that facilitate female participation, which could actually raise the return to domestic investment further. One point that I don't think is mentioned enough, though it was mentioned this morning, was that Germany's a large country. Its global saving depresses the global real interest rate, the global R star. It actually turns the terms of trade against itself and makes the task of monetary policy harder. And finally, there's Keynes's argument from the 1930s, which is that if you invest abroad and there's a default, you lose it. If you invest at home and there's a default, it's a domestic redistribution. And Germany faced this problem in terms of loans to the periphery of Europe. The losses weren't there because the losses were socialized, but that's the kind of thing that Keynes was talking about. Let me talk about inequality a little bit. One point that the handout makes that's very important is that corporate saving has risen a lot. And in fact, corporate saving, together with the change in the government position, but mostly corporate saving, explains most of the increase in the current account balance since the early part of the 2000s. This is true in a number of countries, but Germany is in a class with the US and Japan, and higher than other G7 countries in the amount by which corporate saving has risen. And I think this has implications for how we think about German saving. It is often argued that Germany is an aging society. People obviously need to provision for old age, so they therefore save. This is a good thing. And if that translates into a big current account surplus, so be it. This is what is prudent to do. But when we look at most of this saving coming not from households, but for corporates that are, in many cases owned by the wealthy, and if we look at the distribution of wealth, which in Germany is quite unequal, I think we have to ask the question, who is doing the saving, and is the bulk of the population really ending up better provisioned for old age because of it? I would argue that if one were to determine that it's mainly the rich who are saving, the case for high saving is weakened. And this also creates a Piketty-like dynamic of increasing wealth inequality, which could be socially counterproductive. So it may be that the current account surplus is not so bad in itself, but that the measures you need to reduce it would actually be helpful in terms of growth, in terms of inequality, in terms of cohesion, so infrastructure, education, et cetera. And these would also reduce the global imbalances. There are, of course, issues here. Having more debt requires more distorting taxes. Not a good thing. Germany's output gap is closed. What about that? I would argue that to get inflation to 2% in the Eurozone, Germany will have to run hot, and that would also lead to a reduction in the undervaluation of the German euro that we detect in our external balance analysis. What to do? There may be distortions in corporate governance that could be looked at. There may be scope for wealth redistribution through the tax system. And again, more educational investments would, over time, help address the inequality problem.
Mr. Fuest?
Sorry. Okay, the slides, that's great, thanks. Thanks, Maurice. Okay, thanks for the invitation. So I'm afraid maybe I'll repeat some of the stuff you just said, and maybe I'll also repeat things that were said this morning. I apologize for not being here this morning. So how about the current account surplus? What I'd actually like to do is, just start with the mere facts, and we've just seen some of those facts, but just to remind ourselves, how is this developed, how is the surplus developed, and where is it coming from? So if we go back, on one of your graphs, we've seen it, if we go back to the start, to 2001, so close to the start of the euro, that was a year where the German current account was more or less balanced. And now we're at 8%, so what has changed, and it's just been mentioned, basically two things. So it's not private sector savings. Private sector savings are more or less constant. It is the government, that's the red line here. So in 2001, we had a deficit of 3% of GDP. And now we have a surplus close to 1% of GDP. So that's half of the change. So half of the change is due to change in government policy, and the other half is corporate savings, as was just said. Okay, so what we see basically is fundamental shift in savings, and we have this debate. Does Germany not invest enough? The answer is maybe, but that's not something that has changed, because investment hasn't changed. Of course, this is gross investment. If you look at net investment, so investment after depreciation, that's a bit different, but that's artificial because we had a huge boom in the 1990s due to German unification, so we're writing off a little bit more. But there's virtually no change in investment in Germany. And something else that's interesting is that public sector investment is, does play a role, but it's at 2% of GDP, so it's not something that's very big. And if we change that, it will still be something that's not very big. We can do that. We can, we're trying to bring up public investment now. There are different impediments, problems to implementing that. But if we're very successful and increase it by 10% a year, it will be 2.2 and then 2.4%. So changes in public investment will not change the current account. It will have a small impact, but not very much. So here you see, if you compare Germany to other countries, you have a decline in investment in Italy, in the United Kingdom, in the United States since 2001, but not in Germany, or a very small one. So what's really happened is a change in savings, as we've just seen. The current account surplus is not a result of low investment. It is a result of a sort of a shock on savings. Okay, so and we've just seen what's happened. So part of this is a change in fiscal policy from -3 to a surplus of +1. That's half of the shift, and the rest is happening in corporation. So we have a shift in savings, and the kind of standard explanation or justification, as we've just heard, is aging. We have an aging population, so people understood this around this time and then started to save more. Is this something that will not be to the benefit of the average population? My view would be a bit different from what Maurice just said. We need to remind ourselves that the wealth inequality statistics do not show the pension system, which is a pay-as-you-go pension system. So I would say, the savings we see in the public sector are savings that will benefit our pensioners, and that's precisely, the key reason why they've been undertaken. One of the key reasons for the shift in fiscal policy was that we, the insight that we have this aging population combined with a primarily pay-as-you-go pension system, so we better, get our things in order and produce some kind of surplus to be able to cope with the huge wave of pension payments we will have to finance in 10 years. Okay, so this is wealth that is going to benefit the average population, unless you think that deficits in the public sector would not have led to lower pension growth, but that's unrealistic. I think that pension growth is very much related to the state of public finances. So these are savings for the broad population, and they are very necessary. Okay, so the more complicated story is how to think about savings in the corporate sector. And what's going on here in the corporate sector is very much savings in the form of foreign acquisitions. So German companies are investing a lot abroad, and if you look at this with the simplest possible model, which is a model of a small open economy with capital mobility, and this small open economy experiences a shock in savings, what's the optimal reaction? Exactly what you see here. You invest more abroad. You don't invest more at home because the interest rate doesn't change, so you invest more abroad. Exactly. So what you could say what's going on in Germany is we have a shock in savings. People have understood or think they need to save more, and the optimal adjustment is to save the entire increase, to invest the entire increase in savings abroad. Now you could say, okay, Germany isn't a small open economy. It's a large open economy. So what's the impact of German savings on the world interest rate? It's very small, but maybe it's there. So in that case, you get the same result, but with a slightly smaller increase in foreign investment and a slightly larger increase in domestic investment. Where does that leave us? I think there are. I don't think we shouldn't be worried at all about this surplus. I don't think so. I think there are maybe 3 reasons to think about this surplus. But I guess they are more political than strictly economic. So first of all, we have the 6% rule in Europe. You can think it's not a very smart rule, but we have that rule. And if we expect other countries to respect rules, we should also respect this rule. The second thing is that creditors are seldom loved in the world. Okay, so the more you become someone else's creditor, the more other countries will think about reasons why they might not have to pay back this money. I think it's perfectly plausible. And then they start off, can we not transform this into transfers and God knows what. So that's another reason. And then there's this point also emphasized, and I think rightly emphasized by the European Commission, the IMF and others, which is, look, you have some sectors in Germany where you have impediments to investment, the service sector and the energy sector. And don't you want to remove those objectives? I think, yes, very good idea, but this is totally independent of the current account. Even if we had a huge current account deficit, we still wouldn't want, inefficient barriers to investment in any of these sectors. So it's something that, if you think about it, doesn't really have very much to do with this current account surplus. So, I would say, of course, if other countries have a problem, a lack of demand, a short-term issue, it's nice, if someone came along and bought, increased their demand. But, that's the question of global optimality, globally optimal steering of demand policy and, other maybe slightly utopian things. Thanks.
So thank you very much for the organizers for the invitation. So actually I have some figures that you already have seen already, but I offer you my interpretation of essentially the same set of facts. And so let me start with the assessment of the IMF. So we all know the current account is high, 8% of GDP. The question is it too high? And many observers, especially from outside Germany, including the IMF, says, yes, it's too high. So the current account norm is roughly 4%, and the gap is also 4%, which would translate into an excessive trade surplus or an excessive capital export of roughly 150 billion euro per year. So I should be very clear. For a country like Germany, for the capital abundant economy like Germany, it's perfectly normal to have some current account surplus. Right? It's called downhill capital flows, that Germany as a capital abundant country should invest and let capital flow downhill to countries where capital is scarce. And on top of that, we are this aging economy, and we want to save for retirement. But all of that is part of the fundamentals. That is part of the current account norm. So in my remarks, I will try to focus on this abnormal part, on the current account gap. So we have seen this figure as well. So descriptively, the current account surplus that we have comes from an increasing aggregate savings rate, that you see in the right chart, combined with an investment rate that sharply dropped in 1999, right? And then stagnated ever since. And if you look into the change, and Clemens has said that as well, if you look at the change in the aggregate savings rate, you see that household savings are roughly constant over time. So let's say if it were really demography is always in the background, right? But it cannot explain the increase in the current account, nor can it explain this abnormal part, the current account gap, right? So that's kind of the easy part to explain, that there's always some form of demography and the induced household savings in the background. What has really changed is the government balance, right? And the red bars are corporate savings. So I think when we want to get at this abnormal part of the current account, that's what we need to focus on. So, and I'll give you one interpretation where I think this abnormal part of the current account increase and the increase in corporate savings comes from. And that's also from an IMF report. I think it has a lot to do with the wage dynamics that we have seen in the Eurozone and that were discussed this morning in the first panel. Right? So according to the IMF, Germany has vastly undervalued real exchange rate, even as of 2015. Right? And where does it come from? So before the crisis, right, so with the initiation of the euro, within the Eurozone, we had the wage restraints, the falling unit labor costs that we were discussing this morning, where wage growth in principle should be follow the rule productivity growth plus inflation. It didn't. There were vastly decreasing unit labor costs, and that came with the imbalances within the Eurozone and rising wage inequality. So after the crisis, this has changed. So as Peter Muffinger has said this morning, now wage growth is back, and you can see it in the figure pretty clearly that German wage growth is now more or less in line with the goal, right, with the growth rate of productivity plus inflation. But the point is, there's still this undervaluation because Germany hasn't really made up for the pre-period. Right? So if you had these low growth of wages in the pre-period, right, you need to have higher growth than target in the period after the crisis to make up for these gains, right, in competitiveness, in price competitiveness that Germany has accumulated before. So I think this still prevailing real underappreciation of the German real exchange rate is still one of the important drivers of the unexplained part of the current account gap that Maurice was mentioning. So this low wage growth, we can look at that also from another perspective. So we should say, since the German current account surplus is mostly a surplus in goods trade, so we can kind of ask ourselves, why does Germany export so much? And the second case, why does it import so little? So this excessive exporting, I've explained just now, I think this undervalued real exchange rate coming from the low wage growth, that explains this extra competitiveness and the extra performance of German firms on export markets, right? So, of course, we know German firms offer excellent products of the highest quality, but this has always been true, right? This was also true in the 1990s, right? And this undervaluation within the Eurozone gave these firms an extra boost, and that explains the strong export performance. So, but then we can say, what explains the low import performance? So the deficit in imports, so to speak. And I think there, the low wage growth comes in as well, because we can say this extra money that is earned on export markets is not shared enough with workers. What happens instead is profits are rising. So you can see it in the left panel there, so that the share of profits is rising in the corporate sector in Germany. And these profits, they are, as I said, not shared with workers, not paid out to shareholders. They're largely retained profits, and these profits are largely retained abroad. Right? So coming back to this decision saving at home or abroad that Maurice was mentioning, they're saved abroad, so retained profits are kept abroad. And how are they kept? Partly in form of direct investment, right? So FDI or equity, but a good portion of it is short-term portfolio investment, currency, and loans. So with a bit of oversimplification, I know the current account is a difficult object, but with a bit of oversimplification, I call this, what I see in the data, I call it to myself exporting on tick. So that boosted by the very favorable real exchange rate, you have this export performance, and essentially what you do, you give your customers a loan to buy your goods. Right? And that explains this increase in the loans that we see there, and a good portion of the increasing net foreign assets that Germany holds. So I'm not saying that this is irrational. Right? It can be very rational. At the end, it's a decision of German firms where to invest, and apparently they find it more profitable to assemble these type of short-term assets rather than to repatriate the profits and invest them in Germany. Right? Neither am I saying that German investors are somehow inferior to investors from other countries and just waste money. But what I'm saying is that this dynamics here, for sure, they cannot go on forever. Right? So this assembly of short-term assets is not something that we can continue for very long, and it also puts Germany into quite risky position if there was ever some sort of default on this portfolio, because then we would have effectively given away our exports for free. So to sum up, I think there are two key problems that I've alluded to. First is too low wage growth, and the second is too little investment, in the sense that Germany appears to be too unattractive as an investment destination, so that even German firms prefer to keep the money in short-term foreign assets. So, and I agree, these are two problems that exist independently of the current account. Or in other words, I think of these two problems as reflections, or the current account are reflections of these two deeper problems. And also the solutions should take this serious, right? I think no German household will be happier if they read in the Bundesbank report that the current account surplus of Germany has been reduced from 8 to 4%, right? But I think many German households will be very happy if wage growth picks up and if the domestic economy becomes a more attractive investment destination again. So if that diagnosis is correct, right, then the therapy looks pretty straightforward, right? We should raise wages or boost wages and foster domestic investment, right? The trickier question is, well, how to do it, right? And I think the first panel was about this. And another tricky question is, why hasn't it happened already, right? So which are the distortions that explain this low wage growth and the low domestic investment? And I'm afraid I don't have many insights on that, on these distortions, what really explains it. Another conflict or another point that came up is that seems to be an apparent conflict between what I would call an open and a closed economy view. Right? So from a purely closed economy perspective, we heard about it, so we are maybe about to overheat, and we're in an area of full capacity use in Germany. So how can you think of expansionary policies in Germany when we are kind of running in full capacity? So let me just end with some final remarks. What to do about these problems? And the first thing, I also want to say something on public investment, not because I think this is the most important instrument to use, but because it's the instrument that can be used most easily, right? By public policy. So I agree that there are investment gaps. I think we have heard about them. I mean, there's always this issue of how to measure public investment exactly, what to do about, for example, the salary of teachers, which are counted as public consumption, but when we say that there are deficits in the education system, then obviously we want to have better teachers and attract better, more qualified staff into the education system, and that would not be qualified as a public investment, but as public consumption. And we heard several other measurement issues about public investment. So I think we should think of this not really through the perspective of the current account. We don't want to invest in infrastructure to reduce the current account. That's not the issue. I think we should think of these long-term investments rather like the repairing of the roof that we've heard of. And I think by now there's evidence from various sources of these investment gaps. And most importantly, there are now several micro-founded studies. For example, the German Federal Ministry of Economic Affairs has one of those that calculate even conservatively what would be the rates of return on these public investments, taking into account all sorts of behavioral responses and not relying at all on any Keynesian elements, purely the perspective like what would be the effect of public investment on long-run productivity and the output potential. And these studies, even in the conservative benchmarks, have very, very strong returns. Right, so that these public investments, that they're worth anyway, completely independently of the current account. So we should do it. The question is, why haven't we done it already? And that's a very interesting question. And I think what you hear is a lot about capacity constraints, about planning, right? So that we want to invest, but there are not enough projects that are ready to be implemented, because apparently in Germany it takes a very long time to just make a program ready and get started. And obviously, I mean, this is part of public investment, right? Even if it's not counted as public investment, we should spend more money on the planning capacities, just like on the education of the staff in the education system, to then implement the traditional infrastructure investments that we definitely need. And the other thing, and that should be my last remark, 90% of investment in Germany is private investment. So it would be naive to think that public investment alone can do the job, right, of reducing the current account or saving or tackling this investment gap that we have more broadly. But the same studies that I've mentioned, they show that actually public investment and private investment, they're largely complementary. Right? So for firms, a good infrastructure, for example, in digital networks, is a prerequisite to invest in Germany, and infrastructure gap is one of the impediments to private investment, and that's very clearly what's coming out of these studies that I was mentioning. And on top of that, all the other impediments, so there are surveys of firms, Michael Hüter is sitting there, so IW Köln does this, and we see very clearly that there's still an abundance of regulation, an abundance of bureaucracy that is impeding private investment, right? And I think we should tackle these problems with a combination of public and private investment. It's a combination of an increase in spending, wise spending, I should add, wise spending on public infrastructure combined with structural reforms. And last remark, I mean, if that comes with a stronger wage growth in Germany, that's part of the solution and not the problem. Because remember, one of the key factors why we have this excessive current account surplus is that wage growth is still too low. So we should think of some form of wage growth in Germany, not as a problem, but as part of the solution. Thank you very much.
Well, four economists looking at the same data and still coming up with different stories. I guess that's my destiny. Speaking last year, my starting point was to say that the German current account is a highly unusual phenomenon. If you look at 3,570 available observations of the current account, from 1999 to 2007, we have only 240 episodes of 3 consecutive surpluses of more than 7.8%, and even less if we take 8% as a threshold. Now that's basically raw material and oil producers. There remain only a few that are above that threshold, and among them is Germany and China. Now, if you take a sectoral story, a sectoral look, I would qualify a little bit the story of Clemens. I think if you start with the beginning of monetary union, so end of '98 data, you see that the largest part of the increase comes from the non-financial corporate sector, followed by the general government sector, and only then the household sector. So to my mind, it's mostly a corporate, non-financial corporate story. And if you decompose the non-financial corporate sector into the savings side and the investment side, it's basically 50-50. So half of it comes from an increase in savings, the other half from a fall of investment. The increase in the savings partly is driven by by a falling wage share, while the investment comes from a variety of sectors. And here I plot Germany's investment performance relative to two of our neighbors, and the next slide will also have the US. As you see, the manufacturing investment in the manufacturing sector has been, really falling for a number of years throughout monetary union, and is well below Italy and France. In services, well, we are doing better than Italy now, but only because Italy is basically in a crisis since 2008 or 9. We are still below France. If you take a different view of investment, sort of what is tangible and intangible investment, and there is some computations of how you, how to capture intangible investment done by Eurostat here. And what you see here is that, overall Germany's investment is rather on the low end, hasn't increased, has rather fallen compared to 99. And is certainly in the intangible sector very clearly below France and the United States. So there seems to be an issue here with investment. Now that translates into a capital stock development that looks very, very different in those four economies. So again, those four economies are all advanced economies, competitors of us in a sense. And I find it striking to see that the real net capital stock in Germany has increased the least of all of these four countries, even less than Italy, that is in a crisis for so many years now. Okay, Italy is now flat for a number of years, but so great. We are gradually catching up with Italy here. Employment over population, now that's sort of the other side of the story. The flip side of the story is that Germany has had an excellent employment performance. Of all those countries, Germany's employment measured in population, because demographics plays a role. Of course, the United States has a very different demographics. But if you take the employment rate, Germany has done really great, while the United States, France, and Italy much less well. That leads to a capital labor ratio that looks dramatically different across those four economies. Germany has had the least growth in the capital labor ratio, while the United States has roared ahead, and France also is very, very much ahead of us in terms of capital to labor intensity compared to the benchmark 98. And we can debate whether 98, 99 is the right benchmark. Of course, there were reunification effects in the 90s and so on and so forth. So we can debate what's the best reference date, but I took that date because it's the starting sort of monetary union. Well, capital labor ratio not doing great. What does that mean in terms of the wage share? And here, I think I sort of want to add an element to what we said before. I think there is a connection here between capital intensity of production and the wage share, and so the wages that are basically paid to society. And Maury mentioned Piketty. Well, Piketty's results only hold if you assume that capital and labor are substitutes, and he has some estimates that have by now been heavily criticized on that they are substitutes. If you take Rob Lawrence research from the University of Harvard, most of, do a survey of capital and labor substitutability, you will find that it's usually complements. And if you agree with me that labor and capital are complements, then a falling capital labor ratio, or relatively falling capital labor ratio, would go hand in hand with a falling wage share, while in the two countries, the other two countries of the Eurozone, France and Italy, the wage share has actually increased throughout that monetary union, which I take as an indication that we have here an issue that comes from investment to the labor share and therefore also to the savings side of the corporate sector. So the two things are connected. Now we have talked about the wage developments. Yes, the wage developments are by now picking up, and they are now firmly above the Eurozone. Well, the truth is they are firmly above also because the rest of the Eurozone has fallen quite significantly, but there is an increase. The increase is supported by the closing of the unemployment rate. So we do have here a Phillips curve that is still pretty functional, and that of course is counter. I mean, the wage effects, of course, at this stage are attenuated also by the massive inflow of migrants from the EU into into Germany. We are now talking of currently around 300,000, so 2015 data, 300,000 net immigrants into Germany from the rest of the EU. If you take the gross numbers, we are talking of 900 gross people immigrating into Germany from the rest of the EU. These are mostly labor migrants, so we are not talking here of the refugees. These are people coming usually in the context of the labor market, like free movement of labor, and so that attenuates, of course, some of the wage effects. But even so, it results in increase in employment, and investment doesn't seem to keep up with it. So the capital labor ratio continues to be performing weakly. Now, what's my conclusions? I guess the first point I want to make is this is not something usual. It's something we should look at, and I'm glad we devote a panel to it. I think it's important to dismiss outright wrong explanations. Aging as such cannot explain the increase. I mean, it can probably increase sort of the norm of a 2, 3, 4%, but there's been no major demographic shift, and also the household sector is not behind this increase in the savings. FDI, some people say, well, it's basically German firms now doing massive FDI in the rest of the world or in the rest of Europe or even in Central and Eastern Europe. Well, I looked at those numbers. There's no clear trend there, unfortunately. Well, then there's, of course, monetary union. You alluded to it. Of course, the weak exchange rate is not helpful, and without the euro, the Deutschmark would appreciate, but guess what? We have the euro, so it's not a very helpful comment. So I don't think that will do much to change it. So what can we do? Well, I talked about the fact that labor capital and labor are complements. Well, then a lack of investment would translate into falling labor income share. The increase in German employment, the weakness of investment, and the fall in the labor share are therefore probably connected. The reversal is ongoing, but it's still quite slow. What would be my sort of 3-4 policy suggestions? Well, I think we've talked about the public investment, but the public investment is a very small part of the story. I think it would be very useful if the new government that we may have at some stage in Germany will focus on thinking of how to increase corporate investment, both in terms of the low intangible capital stock, so that comes under the whole heading, has Germany missed the digital revolution? And of course, also at the manufacturing sector where I showed you that we are really doing much worse than France and Italy. There's the regulatory toolbox. I note a lack of significant supply-side reforms in the last 8 years. And then there's, of course, corporate tax reform. Well, we've just passed a major reform in the US that gives 100% depreciation allowance, 100% expensing for corporate capital investment. Well, that certainly will increase the attractiveness of the US as a place to invest. And will increase the pressure even further on German corporate investment. So I think there's certainly a case to be made to look at the corporate tax in Germany and depreciation allowances. Overall, I think such a set of measures should lead also to an increase in the wage share, and combine the investment with the increased wage share will eventually lead to a fall in the current account, which I agree shouldn't be the target, but I think it's a sign of the underlying pathologies that the German economy is suffering from.
Well, thank you very much for a very interesting first round. I think it's not true that if you bring 4 economists on a stage, you end up with 5 different views. I think there have been a lot of recurring themes. I want to maybe entertain a second round of more interactive discussions and then open up the debate for questions from the audience. I think one of the recurring themes I have heard is the swing in the current account surplus is due to an increase in saving of non-financial companies. And what I wonder is, in your view, what is the most dominant driving factor for the increase of saving within companies? So why are companies saving within companies, use non-financial companies as a savings vehicle, and why don't they redistribute the profits? I've heard an explanation that they invest abroad. I'm not sure whether this really fits to the data we have and the studies we have, where we find, at least when it comes to domestic investment and foreign investment, there's more a complementarity than a substitution effect. But I would be interested in your view about driving factors for saving in non-financial companies. And one issue I have not heard, and maybe I would like to start with Maurice to address that, is even if there's no policy distortion, even if there is no problem, let's assume we have policymakers at the global level who think that the current account surplus is a problem per se, and who might even think that bilateral current account positions are problematic. To what degree would you think is wandering around with large persistent current account surpluses then posing a risk for the multilateral trade system?
You know, as economists, we tend to view bilateral balances as a byproduct of the international division of labor and specialization in production, all of which raise global efficiency. And so we're very, hesitant to focus on those. You know, that being said, those can be analyzed in the context of standard trade models. They're not often done, but it can be done, and it is possible for a given bilateral surplus to exceed the norm, the model implied norm, when there are, for example, restrictions that make it hard to sell into a particular market. Those are obviously providing ammunition for trade tensions at the moment, but it's not clear what countries can do about them other than to, in cases where there are obvious barriers, to dismantle them. And I don't think Germany is one of those cases. In terms of the global picture, there's also a threat of retaliation, of trade restrictions, of inflaming the protectionist forces in the importing countries, and I think that is a risk. It is a theme that goes back a long way. It's not something that started in November of 2016, but it certainly has intensified, and I think it remains to be seen where we end up on this. We haven't had a major blow up so far, but there are actions being considered that could lead to problems. I don't have a good answer for the rise in corporate saving, and it's something that we've noted in a number of countries. It seems to be a theme. As I said, it's a much more extreme phenomenon in some countries than others. And it may reflect simply domestic investment impediments of various kinds. It may reflect the fact that we've had rather low demand for a while, and that it may actually dissipate now with higher demand. But in the case of Germany, what I would come back to, which I think was echoed by a couple of the panelists, is that we really need to ask about marginal investment returns at home versus abroad, and particularly in the case of public investment, I think whether it's small or not is kind of irrelevant. And I think from the German perspective, reducing, from the purely German perspective, we should really focus on efficiency. And it could be that even though public investment is small, the marginal returns are very, very high, and those should definitely be taken advantage of. Those, more than government surpluses, I think will promote growth, will promote resilience, will equip the economy to take care of the old later on.
Well, Clemens, I've heard a lot that more domestic investment might be a good thing. What do we know about the impact of public investment on the current account surplus? I mean, increasing the productive capacity of your domestic economy is one thing. That the impact of that on the current account, is that something you feel we can comfortably say that is a clear-cut case?
First of all, I think, if we want to understand German investment performance, is it too low, is it too high? I think it's problematic to do, this kind of benchmarking starting in the late 1990s. I mean, we've had German reunification with a huge investment boom, okay? Other countries haven't had that. So, if you take, the late 1990s and then say, look, investment didn't grow as in other countries, I can only say, thank God it didn't grow like that, because we have, had massive investment in Eastern Germany and, overcapacities in the housing sector in Eastern Germany. I think it's, if at all, it is more instructive to look at the West German states and look at their investment performance. So there maybe it's a different story. If we look at other countries in Europe, those that were most hit by the crisis were those that invested most domestically. Spain, domestic investment can be terribly inefficient. Foreign investment can be inefficient as well, but it really depends on what you do. If you get a misguided investment boom, I don't think we want a Spanish-style investment boom in Germany. You've had wonderful public investment projects in Spain. Huge airports in the middle of nowhere. Nobody uses. They are still there. You can still look at them. It's a total disaster. Domestic investment can be a total disaster, and we have experience with that. So, of course, if you have good investment projects, whether abroad or at home, do it. What we normally say as economists is, let's look at the conditions under which investment decisions are taken. If we have no distortions regarding private investments, let private agents decide. I also think it's very problematic to benchmark German investment using ratios comparing, German companies to Italian and so on. These are economies with totally different structures. We have a larger industrial sector, we have different value-added structures. So if you compare investment ratios, the interpretation is very difficult, to say the least. It's not very informative. So I guess one factor that may play a role in explaining the current account change, something we haven't discussed so far, is tax reform. So in these 15 years, we've had a number of measures in Germany limiting profit shifting abroad. Something that is repeated now in a way in the United States. So we've had policies that have induced companies to to reduce debt financing in Germany. To increase equity financing, and this can easily have contributed, 1% of GDP or even more to the current account, measures against transfer pricing and so on. And I would expect now in the US, with the US tax reform, to have, I would expect this tax reform to have a significant impact on the US current account. This doesn't explain all, but, I think it's one factor that may explain the change in savings in the corporate sector. And again, for me, in my interpretation, the change in fiscal policy is a reflection of the aging problem. It's a preparation of our pension system for the future. And that's why I do think aging is important. I also have to say, I think it is significant that this is a unique development. It's very high, the German surplus relative to others, as Guntram says. Still, just on the basis of, running a regression, basically about, realized current accounts, I find it hard to say, this 4% is fine and the rest is the gap. Again, I find it very hard to interpret. Thanks.
So why the corporate savings? I mean, I agree there are special influences. Tax policy is one. Then there's these capital requirements for firms after the crisis. So that is probably rational to respond to that to retain some earnings. So I think these special influences, they play a role. But I think they don't explain the overall pattern that we have seen, this strong increase. And again, I think it's really a reflection of the real exchange rate. So that you earn so much as firms, and there's no need domestically to pass everything on to workers, because as we have discussed in the first panel, apparently for some reason, German unions are very modest in their wage claims, so that just gives a rise in profits. And the real problem is, why are they not invested at home? Why do firms really prefer to go into these short-term foreign assets? And I don't have a good answer to that, but I think this is really the key question we should ask ourselves. What are the relevant impediments to this domestic investment? Right? And turning to the global risks, so obviously, I mean, with this structure of foreign assets, I mean, there is this risk of default. I mean, some people have argued that also in the past, a notable share of the accumulated current account surpluses that we had in the past, that they have been lost in US subprime or in the Spanish real estate market. So obviously that's not something that we want. And I think the risks that we're facing there, they're not getting smaller, right? I mean, if you look at what's happening in the US, the tax policy there, the investment boom that Trump is trying to initiate, I mean, that will further increase the deficit, the current account deficit of the US, and probably give a further boost to the German current account surplus. Right? And knowing how that is interpreted by the US administration, right, that increase in the German surplus will be not something that will be innocuous from a political point of view. So I think the risks that are involved with this, if we continue along those lines, they will not get smaller, they will probably get bigger. So therefore, I strongly agree we should really try to, I mean, if we think of this as a distortion, right, think harder of the worthwhile domestic investment projects, right, and all the evidence that is there really strongly suggests that they exist. They exist. And the question is, why are they not taken up in the public sector and then in the private sector in response to this? And I think this is the best we can do, otherwise we're going to face an increasing risk from accumulating and piling up these type of short-term foreign assets.
Well, so increase in savings, I mean, usually that happens as a result of high leverage and the desire to deleverage. I think for me the question is, and that happened clearly in Japan in the early 90s and has been driving the strong increase in the current account of Japan in the early 90s. Now, if you look at Germany, by now the leverage is very low, right? I mean, so debt finance is one of the lowest in the eurozone in the German corporate sector, but still it persists. So there must be additional reasons, I guess, that make that profitable. I guess one issue is taxation. The other is what are the kind of investment opportunities? And I certainly do think that we should seriously think about, why is there so little domestic investment, and why has it been falling throughout the period, not just in in 99, 2000, but it's been falling especially in the manufacturing sector quite consistently throughout on the graph I showed. So it seems to me there is an issue, and perhaps that relates to what the previous panel, which, I mean, if I may, I think the one point that I find striking, there's a certain growth pessimism around in certain quarters in Berlin, and perhaps that's warranted because our political system sort of only thinks about redistribution, doesn't want to think about sort of investment and the future. Perhaps that's just a political economy reality, but it is sort of I think there is a sort of a depressing thing here that we don't think that Germany can actually invest profitably domestically, and I think we should actually consider what we can do to make investment increase in Germany again, so that our production increases, our wages increase, income inequality gets addressed with it, and so on and so forth. So. Perhaps that's outside, those that live in Berlin will tell me perhaps that's outside of the Berlin sort of political bubble, but I think it's actually at least something that we should, as policymakers, as academics, put on the table here.
Okay, thanks, Guntram. I think if you just take corporate investment as a ratio to corporate value added, then corporate investment is not that low in Germany. It's above historical averages. You could argue it can be higher without any interest rate, but I think it's not on a secular declining trend. It's more stationary variable. But I would like to use the remaining minutes to open up the discussion for the audience. Yes, I think we will collect some questions. Mr. Issing.
Two short questions to the audience. I think seem to all agree that wages in Germany should rise stronger. And there was also the argument that private domestic investment should rise in Germany. Assume for a moment there would be a credible announcement that wages in Germany would rise 5% over the next 3 years. Do you think this would give a boost to domestic investment? And this relates to a general observation. We all decompose current account in different elements. We all are doing that. Then we treat the different elements as independent of each other. There is an argument on increasing one element and not respecting if there might be consequences for the other elements. They are all interdependent variables in the end. And my second remark is, Guntram, I was very puzzled by your presentation. According to some of your graphs, Germany is dramatically underperforming in relation, capital, labor relation, etc. And you take Italy and France as a benchmark.
And the US.
You took France and Italy as a benchmark. Don't you think that this capital labor relation, wage share, etc., is contributed to the underperformance in growth, employment of these countries? Again, you cannot treat these elements as independent of the rest of the economy.
David Marsh.
Yes, just a very short question. I think there is a problem of getting this message across to the policymakers. Just as Guntram said, this is rather depressing. Somebody's going to be coming for that money. As you pointed out, Clemens, there's repudiation, there's debt forgiveness, all these things. You're not particularly popular, and you seem to have a lot of money. Somebody like bank robbers, they will come after it. So you need to be doing all the good things that you're saying in the interest of self-preservation. The question is, how does this extremely good, extremely clever series of messages that we've been hearing today get across to the policymakers in Berlin and elsewhere? Because I don't think that they are paying any attention at all, and that's the completely depressing conclusion. So tell me that I'm being unnecessarily depressed.
Look. Is there a micro for Mr. Schuknecht?
Thank you. I don't know, maybe I overheard it, but we haven't discussed the German current account surplus much within the context of the current account surplus of the monetary union. And the monetary union's current account surplus has increased from 0, I think, in 2007 to about 3.5% now. Germany's was 6%. So relative to the euro area, it has gone down because within the euro area, the German surplus has gone down, which reflects the adjustment, which is a good thing. I think one should also take account of that. But we've also not discussed much the German policy environment related to the surplus and the weakness of other countries. I mean, I think one needs to think this together, like Ottmar Issing said, with the behavior of other variables in other countries. Don't you think that, in a way, if you appeal to Germany, it requires an appeal to, so to speak, the countries that have been on the weak side? And if you look at the overall surplus of the euro area, don't we have a legacy issue here still from the crisis? in the sense that, I mean, German companies are holding cash because, you know, they were cut off from liquidity in the crisis. Other countries the same. Deleveraging needs, overinvestment in other countries. So in a way, if there is still a legacy issue from the crisis, should we not also be a bit relaxed? I mean, just like it takes a while for inflation to pick up, it takes a while for these mechanisms, this adjustment, post-crisis adjustment to kick in, so that we, on the timeline, can expect the euro area current account surplus, and with it, the German one, to go down.
Thanks, Ludwig. Given that we've already 3 p.m., we've collected a couple of questions. I would ask the panelists to respond to these questions very briefly.
Okay, you know, on the first point from Ottmar, I mean, I don't want to speak for other panelists, but you know, I wouldn't argue that I would certainly not argue that exogenously higher wages would improve investment prospects. But I think what I've been trying to say is the reverse, that higher investment would raise wages. And I think one wants to focus on the investment incentives and you know, whether Germany is better off investing more than more at home and less abroad. You know, on the weakness in other countries, you know, hard to say how that affects everything. Certainly in our analysis, which is more medium term, we try to look at the fundamental determinants of each individual economy and try to assess where those are. I'm uncomfortable, you know, for Germany to sort of hide behind the overall surplus of the Eurozone when it has its own fiscal policy and is you know, not part of a political union. I think the view we take is that each country that has an independent fiscal policy is, you know, going to be where it is. Now, it could be that part of that residual has to do with the monetary union, the fact that, you know, with Germany sharing an exchange rate with a number of countries with basically very different levels of competitiveness, there's just going to be an additional surplus there that we can't easily explain in terms of those fundamentals. And that might be something that complements your explanation, but is not unrelated to it.
Yeah, maybe a point on the crisis legacy. I mean, I guess that's well known, but we haven't discussed it here. So one issue is certainly that we are trying to maintain the capital flows to the periphery. We have been trying to maintain them for a long time, you know, to prevent spending in these countries from declining, and that is in contradiction with the idea that we want to bring down the German current account surplus. So we can, you know, have one of the two, you know, the question is, you know, how do we strike the balance? But that's,
they can borrow from other countries, but Germany. I mean, Germany is not the sole.
Yeah, but still, you know, it's big. We've said it's a big economy, and you know, a lot of capital flows go through the European Central Bank system. Target balances are at 900 billion now, so it's clear that the European system of central banks is channeling capital to these countries. So it's not entirely clear, you know, at least it's not plausible that this is helping to bring down the German surplus. So quicker adjustment there would have helped, but it would be a problem in terms of, you know, stabilizing demand in these countries. So I guess that has contributed, and indeed the target balances also contribute to bringing down the return on German foreign investment. That's true, and that's why I think we would need to address that as well.
Mm-hmm. Yeah, so maybe two remarks on the post-crisis legacy. So I agree. I mean, things have gotten better in recent years. So after 2009, 2010, I think we're moving into the right direction, also in terms of wage growth. But as I said, I think we're not quite there yet, because there's a long way to make up for the developments before. But at least we're moving in the right direction. So I think that's the good news. And well, on the general wage growth, exogenous wage growth, I think this is inconceivable given the German institutional structure. So I don't know what will happen, but I agree with Maurice. Investments if we engage in them, they will in turn endogenously lead to higher wage growth. And I just can refer to the studies that I was mentioning several times now, right, where kind of you simulate the effects of investment projects really in a macro model and all the sorts of implications that come with it. And at least these simulations strongly suggest that, first of all, there's a positive effect of investments on wages, a positive effect on wage inequality, which reduces, and this complementarity from public to private investment, because the meaning of public investment is really this increase in long-run productivity, which in turn will have positive effects on wages, private investments, and so on and so forth. I think we should think about it this way, not from an exogenous wage increase, because it's hardly conceivable, but try to think of the implementable policies that will have repercussions for the wages endogenously.
Well, also on the last point on the weakness in other countries and now being a little bit more relaxed, I think that's why I showed the Phillips curve that actually is still in place in Germany, and we do see wages picking up. And the one attenuating factor is incidentally a factor that sort of macroeconomists actually like, right, which is labor mobility, right? So basically the unemployment problem, the unemployed from all over the EU migrate now more and more to Germany, and Brexit will probably accelerate that, so that wage developments will be dampened by that labor supply effect. Now, as regards, I don't think anybody on the panel asked for an exogenous wage increase, so that's not the issue. It's about can we set the incentives right for more investment, and would that then endogenously lead to higher wages and higher wage share? I think all the empirical evidence on capital and labor being complements suggests that it would. So I think the real debate should be about what are the incentives for investment? Do we have obstacles in certain sectors for investment? And I would probably say yes. So the causality, it's not really, it's difficult to talk about causality, but nobody certainly was suggesting a policy experiment, let's exogenously increase wages. So I was surprised by that question, Ottmar. First panel, okay. I missed the first panel, so that's...
Okay, then before the last panel combines that climbing up the ladder of complexity with the European dimension, I would like to use the opportunity to thank all the panelists for a very stimulating discussion, and we'll meet again at 3:30 sharp.